Monday night or making additions. Okay, so welcome to this lecture on risk and return. This is the first lecture which is going to look like, in a sense, the rest of the subject. A little bit more mathematical, introducing a few new conceptual tools, and discussing a bit of finance. So what we introduced last week was this idea of this risk versus reward trade-off. And I was saying this was one of the fundamental concepts in finance. The idea that assets that are more risky tend to have higher returns. And we saw that last week historically with the data from the 1970s up to 2000s, that the ordering of these assets in terms of riskiness, a risky company shares regular large company shares bonds and short and long-term bonds, that the higher were the riskiness of each of these, measured as the variance of the returns over time, the higher were the returns. So we saw that, this is precisely as we would have expected, that the assets that are more risky also tend to pay higher returns to the investors. So we're hoping we'll find this to be a common theme through the course. And later on today, we'll be talking a little bit about this diagram, in particular, the slope of this diagram. That'll turn out to be something important called the Sharpe ratio. And we'll be discussing what the Sharpe ratio means as well. So this is a diagram to keep in mind. So one thing we might want to ask then is, okay, what are we measuring on the horizontal axis here? So what is risk? We'll be talking about that today. And then what are we measuring on the vertical axis? Return. So today we'll be starting to do some of the mathematics around this diagram. Okay. So as I said, the first question you might want to ask when looking at that is, it seems very nice, but how exactly do we operationalize this sort of diagram? How are we going to go about and measure return? What exactly does that mean? How do we go about and measure risk, and what does that mean? And then what's the relationship between risk and return? Does it look like this diagram, or is it something different? As I said later, we'll be talking about the Sharpe ratio, and that's going to essentially explain what the slope of this line is. And is it a simple curve like that? So just some definitions. This should all be familiar from Fin 211. Return is just the gain in the asset over a period of time. And typically we'd be looking at that in terms of a cash flow to an investor. We'll talk about it. There's both typically a capital gain and a yield in our returns. Now, as I said last week, there are some assets that people hold that obviously give a non-monetary return, something like owning a painting. So you buy a $2 million painting to hang up in your office. It's returning some sort of value to you as the owner of this painting. You can go by and show your visitors the painting and say, look, that's an original Gauguin. And everyone goes, ooh, and they think how wonderful you must be to own that. That's not the sort of assets we'll be talking about in this subject. Those sorts of monetary assets that give a non-monetary return are quite different. We'll be talking about assets that essentially are valued in terms of the cash flow that comes from them. You could think about a painting that you keep in a vault. And so some people do that. They'll buy a painting and then they'll stick it in a vault. And the return then for them, well, you'd have to wonder, they'll have a capital gain. It's going to be the increase in the value of the painting over time. Of course, there won't be any cash flow. There'll in a sense be the cost of keeping it in the vault. I was reading an article in the Australian over the weekend, and there's this woman who's a professional forger. What she does is she makes copies of paintings. So you buy a very famous painting, say a Mark Rothko, and your Mark Rothko, because it's worth $5.4 million, you keep it in a vault. And then you have this woman make a copy of the Rothko, and that's what you stick in your office and what people buy. And so you get to show off your Rothko, which isn't really a Rothko, it's actually a James Stevenson or whatever. But you got to know that your Rothko is also safe, it's buried somewhere. But typically we'll be talking about assets that have cash flows. And so in finance what we'll be doing is essentially setting a value to that asset by saying it's equal to the value of that particular, of the cash flow that comes from the asset. Okay, so we're going to try to define return. Typically, we tend to think of two different types of returns that come to you for holding an asset. There's the income, or also called the yield, right? And the income will tend to be some cash that's coming to you regularly over time. It might be the dividends that flow from owning a share. It might be the interest payments that come to you from having something in a bank account or owning a bond, right? These regular bits, dribbles of cash that come to you as the owner of this asset. But then there's also this capital gain, which is the change in the price of the asset. So if you hold a share, you've got really two types of gains that come to you. One is the dividends that are flowing to you whenever the company reports dividends and hopefully a profit. And the other is the change in the share market value of the share. Right, so there's two parts of returns. One is called the yield, so that's the income, and the second is called the capital gain. That's the change in price of the asset. And so what we're going to call total return or holding period return is simply the sum of those two. You're getting some yield return from holding your asset, and you're getting some capital gain from holding the asset. So the assets that we'll be looking at typically are these sorts of things. So when you're identifying an asset, it's important that you identify what the cash flow is that's coming out of it, when the cash flow comes to you and what sort of cash flows it is, and then try to determine a return, which is what we'll be doing in an example quite soon. So if you hold on to a share for a year, so let's say you bought the share for $2.20 and earned 30 cents in dividends, and at the end of the year the share is worth $2.40. Okay, what's the return to you from holding that share? Well, you can break it down into those two terms, right? The yield and the capital gain. So the yield is the income that comes to you. That's the dividends. So you earn 30 cents in terms of the yield. Now, you want to present this as, that income as a percentage of what you put at risk. How much of value you have at risk in order to earn that 30 cents. Well, you paid $2.20 for the share, so that would be the appropriate value at risk to think about. So you're going to divide 30 cents, the income, by $2.20 and get a number like 13.6%. So you're saying your yield return over this year has been 13.6, the income part of your asset value. There's also the capital gain. You've received a capital gain because the value of the share is worth more at the end of the year than it was at the beginning when you bought it. So the capital gain is that difference in the value of the share. So in this case, the share is now worth 20 cents more. So the capital gain to you is 20 cents again over the value at risk, over the price of the share, or 9.1%. Then your total return or your holding period return is simply the sum of these two as percentages. Right, so 13.6 plus 9.1% to get 22.7%. So remember also, always, we'll be expressing returns around assets in terms of percentages. Why do we use percentages? Why don't we use dollars? Why can't you say, okay, my return was 30 cents plus 20 cents or 50 cents? What's wrong with that?
Because if you invest $200 and you just get like that little return.
Right. So 50 cents is a pretty good return on $2.20. But 50 cents would be a really crappy return on $200. Exactly right. So for you as an investor, it doesn't necessarily matter precisely what the number is that you're getting. It matters very much in terms of how that number compares to what you put at risk in order to get it. So in finance, you're always thinking about that there's an opportunity that you're giving up by investing, that there are other things, other ways of investing your money out there. So there's always other opportunities. So what you're going to look for is not necessarily the highest return. It's the highest return. It's the highest relative return. You're thinking relative to all of the other assets out there. What's going to earn me the best return in terms of, and in that sense, where would I want to put my money? And you want to put your money in the assets that will earn you the greatest percentage return. There's another relatively simple concept called the relative return. This isn't used that much. The relative return is just 1 plus the total return. Your total return is going to be percentage. It's going to be, like we saw before, 22.7%. The total return is going to be a number, 1.227 will be the total return in that case. And not expressed as a percentage, just expressed as a ratio. So if the example here is, if we had a $30,000 return on a $50,000 portfolio, then we calculate our total return as 6%, and we calculate our relative return as 1.06. It's not a percentage, just a number.